It's the number one question I get from business owners thinking about selling. And honestly, it's also the hardest one to answer. So in today's video, I'm breaking down the real ways a business is valued. The good, the bad, and the ones they definitely didn't teach you in your accountancy exams. Most business owners only sell once. It's often tied to retirement, legacy, or securing a financial future. So it's no surprise that when it comes down to it, they want to walk away with as much as possible. But how do you figure out what that number should be? Let's go through some of the main ways to value a business. These are commonly used by accountants, investors, and people like me who've bought and sold businesses. 1. Net Asset Value, NAV. This one's simple. Take all the assets, subtract the liabilities, and there's your value. The issue? A profitable business might have a low NAV, while a loss-making business might have a high one. So, not always helpful. 2. Profit multiple, EBITDA. Probably the most common method. You work out EBITDA, that's earnings before interest, tax, depreciation, and amortization, then multiply it by a number. But what multiple? That depends on your sector, size, and risk level. Bigger, stable businesses get bigger multiples. 3. Discounted cash flows. Technically accurate, but honestly, unless you're Warren Buffett or selling to a fund, skip it. It's complex and only works well if your business has very stable future cash flows. 4. Comparable transactions. If a similar business just sold, great, you've got a benchmark. But if the business you're comparing to is 10 times bigger, well, you might look a bit silly trying to use the same multiple. Speaking from experience here. 5. Entry cost method. This one's useful when your business isn't showing strong profits, but there's still strategic value. It asks, how much would it cost to build this from scratch? That's often what buyers consider, especially when entering a new market. 6. Industry norms. In some sectors, like accountancy firms, valuations are based on turnover instead of profit. If your industry has clear M&A trends, this can really simplify things. The broker valuation. And then we have the broker valuation, or as I sometimes call it, the fairy tale number. Brokers make their money up front and they're competing to win your business. So guess what? The one who gives you the highest valuation often wins the work, even if that number's nowhere near realistic. I've met too many sellers who were given false hope this way. What really determines value? At the end of the day, no matter which method you use, all valuation models are really just ways of justifying a number that the seller wants to walk away with. I recently met a business owner who said, I want $400K for my business, because I could live off that for 20 years. And you know what? Fair enough, if someone's willing to pay it. Final advice for sellers. My advice is this: work out your number, the one you'd be happy to walk away with. Ask yourself, is that number realistically justifiable based on one or more of these valuation methods? If not, either adjust your expectations or grow the business to support that valuation. If you do get your magic number, congratulations. Seriously, only around 10% of businesses listed through brokers actually sell, so if you get a deal done, you're already ahead. Could you have gotten more? Maybe, but maybe not. Don't let the fear of missing out ruin the win you did get. If this was helpful, give it a thumbs up and hit subscribe. I'm sharing honest, no-fluff advice for business owners thinking about exiting, scaling, or acquiring. Got questions about your business valuation? Drop them in the comments and I'll do my best to answer. Thanks for watching, and remember, your business is only worth what someone is willing to pay for it.